Thank you. Thank you. Well, I will, first of all, say thanks for having me here to the 500 Startups team. This is all about, a lot about investing and, in this case, raising money. You guys sure know how to run conferences. One of them is staying on time, though, so I'll get on with it. But thank you for having me. And again, I love how you've mixed up the format. I don't know about the rest of you, but it's been a great conference so far. So, you know, the title of this is how we raised this fund in 92 days. I will first off say that certainly wasn't what we expected when we went out. I'll give you a little history of our fundraising, which is not too dissimilar probably from most of yours in the room. And by the way, my comments to you are valuable if you are an investor, a fund of any type, but hopefully also as an entrepreneur, because there are a lot of parallels between both of what we do. We're still new at this. I'll describe how we did this last fund and what I think what we were accidentally lucky and what we were smart about and things I would fix next time. But we're actually still pretty new at this. We're on our fund 4, but I share this to give you the sense that this is still relatively new for us. We were a captive fund at the start of our first 2 funds. We were captive to one LP, so it's a different fundraising, obviously, and not nearly as challenging as it is to go raise an independent fund. We spun out in 2006, sort of midway through our second fund, so that's when we started crawling. We had a lot of secondary investors, but we were out of the womb, and we were off to the races. And it was both terrifying and empowering to finally be in charge of our own future. And then we were just so excited, we were just going to, you know, rock at doing this. And bam, we start raising our next fund. And I think it was the summer of '08, and like 60 days later, Lehman collapses. I remember literally being in New York to pitch to one of our existing LPs, walking by Lehman's headquarters, and they're carrying boxes out on Sunday night, and thought, oh, this might not be good. It took 15 months to raise that fund. I remember a day where my partner and co-founder, Rory O'Driscoll, and I had gotten 5 turndowns in a row. And I remember looking at Rory and saying, you know, we're about 5 blocks away from our hotel. I said, I think we should just crawl back. It just feels like that's what we should do. This feels really bad. But we raised the fund. We stuck at it. And we'll talk about what I think some of the things we did then actually were successful in our most recent raise, but that was a long 15 months. So when we started raising Fund 4 at the beginning of 2013, I sort of told my husband, no vacation plans this year. I thought, you know, our goal was 6 months would be really good. That we'd get our insiders in the first close, we'd get, you know, circle up other people by June, that would have been gold star. I planned for a year, thinking it'll just take that long probably to do multiple closes, no embarrassment in doing that any longer, and obviously 92 days being a bit more than we expected. So here we were on, you know, May 3rd, 2013, like, oh my God, and I'll tell you how we got there. And here's where we sit today looking at Fund 5. We don't expect, you know, it will be as easy. We're like most of us in the room, we're not Sequoia, we don't send out the documents with the pen and say, LP, you get to keep the pen, give me the docs back signed. We're not there yet. So we're gonna be working hard like you. So I love these conversations because frankly, I get a lot from you guys afterwards as well of good ideas that everybody else has learned. And I think the better, you know, we're in a syndicate business as investors. We work closely with entrepreneurs. The more we can share about best practices, the better we'll all be. I think the first thing, and when we stand back, the things that I think mattered to us when we went to raise the fund were what was happening in the market. We'll talk about that first. Our returns and how we position that relative to what an LP needs. And then ultimately what we did, the process, and I'll share kind of the tips and tricks a bit on that. And you know, a lot of you have seen this slide. We have a strong point of view, and this is one of the reasons cyclically it's a good time in venture. You know, you have an oversupply of capital, and we can really squash returns. Too many companies funded, we compete on price, it just becomes a mess. There were a lot of tourists in the market in 2000. Gardeners were, you know, lawyers, you know, investment bankers all becoming VCs. Following kind of the early .com wins. And while the fundamentals in the market were going along really smoothly, obviously funding and pricing got really out of whack. You know, the people that built, the LPs that built funds at that peak, and you meet a lot of them that did for obvious reasons here. I mean, 100 billion was raised at the peak, 10 times what was raised, you know, in the normal periods in the late 80s, early 90s. They really are suspicious of putting money into our asset class. It's illiquid, it's long-term. You know, if you play the index, you're not going to do well. And you heard this earlier this morning. The real learning for LPs from that phase was A, size it as a portion of your portfolio correctly. B, get in temporally, don't do it all at once, which happened in 2000. That was a huge bolus of capital going into venture. And you've got to go for top decile, which is always so hard, particularly when you're an emerging manager. You have yet to show it. Then you look at kind of that little dip that occurred in 08, 09, and that's when we were raising our Fund 3, $255 million fund. That was the financial crisis, which taught everybody, oh yeah, if I wasn't already worried about venture, I have to worry about liquidity too. And we are the ultimate illiquid asset class, and I think it's good news there are secondaries that happen in our asset class. I think that's improved the posture of LPs wanting to invest in us because they know they can move it out, but it comes at a pretty high discount. It's not like a redemption they can get out of a hedge fund. They make a really long-term commitment on average, 12, 14, 15 years to each fund. So we are way at the tail in terms of getting cash back. So 08, 09, they backed away further, as you can see with that little dip. When you look at today, though, and I heard this a lot when I was doing the Jobs Act and talking to institutional investors who are really running the entire portfolios of pension funds and other things, that their biggest challenge was return. When they look at, think about the growth and think of all the places we put our personal capital in addition to startups, it's tough to find return. Interest rates are low, growth in developing worlds is kind of moderate. So putting yourself on the heads of an LP and you've got a foundation to support, pensioners that you have to give returns to, you're looking for return. So if you look at Q1 2014, it's been bouncing around 15 to 20 billion raised per year. The run rate as of Q1 is actually 35. It would be an inflection point up. What's interesting about that, and it's no surprise to a lot of you in the room, I was talking to the folks at Bullpen, you'll be hearing from Paul next, is that it's a lot of money, though, going into much bigger funds. The average fund size doubled this year. So we all know a lot of the big name funds came back in the beginning of the year. That's good for them, but for some of us, takes the air out of the room. It makes it a little tough. And so it's a tough, it's an interesting time thinking where LPs are. I think an opportunity when you know that they're looking for returns and how do we play it. So what's happening in our business, this is from NVCA, over the last 5 years, our industry collectively is tracked by them, and that's their subset. They track it, this is gonna be like for like, 92.5 billion. We have invested 133 billion. So we heard earlier today that overhang is gone. This is 40 billion gone. And people sized it at the peak that it was about 50 billion. An overhang, for those of you who are not in the industry, this is the amount of capital that's been raised and not deployed. And the belief was after that peak, people were slowly still hanging on to their last bits of their funds in order to survive and hope to get returns in order to be able to raise another fund. And the fear that there was this just ongoing overhang that could crush returns on any given year. Well, clearly we have spent that. And the other dynamic that we all know is happening in the industry, which I think for other reasons is very positive, an increase in really sophisticated angels, an increase, and I think increased sophistication of corporate ventures. You'll hear from Intel Capital, Christine, here on later today. And the whole, crowdfunding, online investing platforms, crowdfunding obviously to be eventually get through the FD, but the SEC, but an increase of capital that's coming there. So as traditional sort of venture-like funds, institutional funds, you're competing not only for dollars to invest, you're competing to go into the best companies, so you just have to really work hard to stay in place. As this was a lesson I got from an entrepreneur, in terms of how he was running his company when I first started investing. You've got to be alive to win, and you've got to figure out how to make it happen. So we'll focus on then what we did in the fundraising and what we learned. And I think of this all, and I think this is why this works in the context in particular of this conference. As I was raising our fund, and again, dating back to 2006 and learning this part of the trade, because raising capital is part of our trade, I had a CEO once say to me, CEO, do you know what that stands for? I said, no. And it was a woman, and she said to me, Cash Extraction Officer. I loved that line. And it is, that is part of what you have to do to be, you heard Jeff just talk about what he did with soft tech. Obviously, we have to be good at what the ultimate thing we do is investing capital. That was what earns our right to be here. But you have to know how to raise capital. So the easiest thing for me, and it really, particularly having been in a captive and getting into this business, I really felt a real kinship with our CEOs in terms of how we go about doing these things. So these are the kind of lessons that I think are parables that I think really work. You've heard it a bunch of times today. You get that right. And I think of this in terms of get your product market fit right. And you don't do it by sitting around the room. You don't do it by deciding that you've got the right answer. You actually go out and look at the market and really determine, do you have good product market fit? At scale, we spent a lot of time first sitting down and saying, what is our strategy? Let's be clear about that. We debated it. We looked at our fundraising history. We looked at where we had successes and failures. We looked at what we thought we did. And we really debated it. I mean, this was for us, putting together our first slide deck was actually a very cathartic experience for us, going through and sorting out honestly what we think we're good at. You'll hear later, we invest in what would be that Series B sort of world. We invest in companies just as they're beginning to scale. Early in revenue companies, 200,000 in revenue to a couple million in revenue is what we do. When we went out, we thought it's just so much cooler to be early stage. You get to wear jeans, not dresses. But we decided that isn't who we are. And it's not where we've had our best success. It's not where we had the best value to entrepreneurs. Be who you are. Be who you're good at, and don't be afraid of other people that it's saying that that's not cool. And in fact, it's a great compliment to the people who in fact are really good at early stage investing. So really debate that internally and be honest with yourself and not be what you think someone else wants you to be. Think about where you fit on that investing continuum. I go back, my mom's a nurse. She's in a nursing union. She's looking for her, her pension managers are looking for return for my mom. And I think about my job is to be the best conduit, really, between my mom's need for capital and for, her check every month and the best entrepreneurs. That really is my job. And the best conduit and then hopefully the best, coach and board member I can be to support that company to get my mom her returns. I mean, or it could be a foundation, or it could be a family office, to sort of name your strategy. So when you think about those big pools of capital, or the family offices or other things, think about where you fit in their investing program. We tend to walk in thinking, venture. They've got a much bigger portfolio to think about. Within venture, they've got a portfolio they're building. Early, seed to early to mid to late. Think about what product are you selling to them. And again, we're selling a little bit later, a little lower risk. I think stage is a proxy for risk. So we have a somewhat lower risk. We don't need the because we don't have as big as loss rates, and that's true in the data that we share with LPs. We don't need to have the 10 to 20 X's, but we do need to have our share of 3 to 5 X's with the occasional 7 to 10s, which make you really successful. So think about where you fit and what you're selling, both in terms of return and in terms of time to exit. And focus on that piece of it. When do you expect to return cash? And that is part of what you are describing back to that limited partner. So we live in the world of innovation. We have to have a foot in both worlds, both the world of innovation, but frankly, the asset management world. Think a bit in their terms for a minute and think about what they need to balance out their overall portfolio. Now, the great news is they need return, so that if it takes longer, that's okay. You just need to share that you'll get some really nice multiples. And then go out and test the market. What we did is we went out and put together our first pitch. I'm so glad we don't have a tape of that. I'm sure it's embarrassing. And we went out to 2 friendlies, and we went to LPs. We didn't even go to our peers who probably could be helpful. We did go to a lot of peers, by the way, who were great sources of best practices and things that they wouldn't do again. So that was great. But we went to 2 LPs who we knew wouldn't invest in us for different reasons. One, because they were shutting down. They were really focusing this is GIC actually, focusing internationally and doing a lot of direct investing. And the other was Fairview Capital, in my case, who does a lot in venture but didn't do spinoffs. Perfect. We went through the pitch, and I said to them, I really want your honest feedback. I always think the best friend is the one who tells you you have spinach between your teeth. I really want you'll do me a huge favor. I can go get another day job if the truth is I can't raise money. I mean, you really do want you want, of course, someone to say, attaboy, but really what you want is that honest feedback, both about, do you think this will fly in the market? Is it differentiated enough? Do I need to go back and test my product market fit again? And then in terms of the telling, is it clear? Is it concise? The things that we all know, it's just like an entrepreneur. You know your product so well, it's not always so easy to explain it to somebody else. So get that down, in your head. Then really spend time understanding that specific customer. Again, just like any great startup. it is really, they love it when you sit down and ask them, what is your mission? I mean, if it's a foundation, really understanding and connecting with their goals around education, perhaps, is their philanthropy for that particular family. If it's a pension fund, that they have, people inside, a lot of aging pensioners, younger pensioners, kind of what's their profile, really get in their head. Decide whether or not they have appetite. Are they building, shrinking? Do you have to replace somebody to get in their portfolio? Are they missing a piece? Ask them a lot about what they're looking for, and then figure out where you fit on their map. Figure out, if you can, what their purchase history is. Ask them, sometimes they tell you, sometimes they don't, who they've invested in. That's helpful for you to know. Those are great connections for you to triangulate on. I think a great way is to ask peers, if I'm a healthcare fund, which we're not, who else have people invested in? Who else have your LPs invested in? Who are your LPs? So I know when I'm pitching somebody, what other products did they buy that are like me or not like me, or who I know. Hugely helpful in establishing a connection. And then, of course, what's their process? I'd probably say the #1 secret to our success was the fact that after we started raising in 2006 and closed that spinoff, we never stopped fundraising. We never stopped developing those relationships. And in fact, I would tell you that we've been most active every time we finish a fundraise, because the best time to meet a limited partner is not when you're raising fund. They get to know you, they get comfortable with you, and this is part of what I think is really key, and if we were gonna end on one slide, this would be it. I think it is real, and again, think about us, as investors looking at entrepreneurs. The more I know an entrepreneur, the more I trust them. The more I go from gambling to taking an educated risk about them. And particular in us, we are a 12 to 14, 15-year blind pool that they're investing in. The more confidence they have in what you do, in how you think, in how you deal with difficult decisions, the more they see you do what you say you do, the more they see you hit milestones and do what you've told them that you expect to do, the more confident they're going to get in understanding you and making that decision in investing in you. So I think that ability to get to know them, when somebody calls you, one of the great ways for me to develop relationships with LPs is when they're doing due diligence on my peers. It's a great way to start having a conversation, get in their head. We triangulate how each other start thinking, stay in touch with that person over time. A great way to move forward. I think particularly with our limited partners, and these are both people we know and people we don't know, of course you want to talk about your successes. That's what is going to make us investable. But we teach them a lot about how we deal with failures. And I got the most compliments from our limited partners ever when we quickly emailed them about a product failure in we knew they'd hear about it in the market. I didn't want them to hear about it from somebody else. And we sent an email out to our LPs and talked about why, what our plans were, et cetera. I got the nicest emails back for that. And they said, the fact you were transparent, you told us what you were doing, means you have us in mind as you're always doing your day-to-day business. You're not trying to pull the wool over our eyes. And we got insight into your thinking. And we hugely appreciate that. So don't shy away from, because again, we're in the high-risk business. We should have failures, how we deal with that, people failures within our firm, in our portfolios. Share all that. The other thing I'd say is ask LPs for their feedback, particularly the turndowns. Ask them why they turned you down. Ask them for feedback on individuals in the firm, yourself included. What is it that made us challenging from your portfolio? It was interesting, Jeff talked about how entrepreneurs that he's turned down have brought him deals later. We had a number of the new LPs that came into the Fund 4 that we did in 92 days were people that turned us down in Fund 2 and in Fund 3. So don't be daunted by that. Invest in your product launch. You want to have data on yourself. Think about how to analyze not just your cash flows, but all different ways of looking at what you do. Be ready for that. And be really prepared to analyze yourself like you do a portfolio company. Have data on your limited partners. We use Salesforce to track our limited partners. I think it's really valuable to know that Becky Conley at Fairview is a really big runner. It's great when one of my partners who sees her can use that as an icebreaker, who might be a little bit nervous about going up and talking to her. So it's not even just what their appetite is. It's even some of the personal things. We track it just like you would just like an entrepreneur would do. I think getting us all together, and in particular, I think understanding your brand and message. And we can talk about this, you know, at break or other things, being clear about what you do and then doing it. You know, we invest in companies early in revenue. They grow, you know, on average across the portfolio early and late, they double. It's even often more than that. And we're really concentrated on scaling. We scale our fund. We help our company scale, which is really go-to-market and commercialization strategies. You know, how do you get from 200,000 in revenue to 2 million, 20 million, 200 million? That's what we do. They see it in our portfolio. They see it in the backgrounds of the individuals. We're just about to wrap up here, so I'll wrap up. So what we got in our 92 days was the youngest relationship of our new investors was 3 years old. They weren't starting and finishing in 92 days. They were literally doing the final work in 92 days. We got the benefit of entrepreneurs wanting to concentrate their returns. We never assumed success and got arrogant. We were really honest. And I'll tell you what we did in the 93rd day. Focus on doing what we said we would do with them, return cash, you know, continue our relations, and again, delivering the brand that they purchase, because they want to know you do what you say you're going to do. So with that, thank you guys. It'll be a great rest of the afternoon, and good luck with your race. We're in it together.